Good evening, everybody. Lovely to have you here with us tonight on a very cold and wet pre-Easter evening. But I'm really delighted because it doesn't matter what time of the year it is, what time of day it is, I'm always up for a good HMO chat. And today, the guest on my monthly webinar, my HMO success video, is none other than Lee Dumbarton. Good evening, Lee.
Good evening. Thank you very much for having me.
It's amazing to have you, Lee. I'm really, really pleased to have you. Lee and I really sort of our paths crossed recently when we were on a panel at the Property Investor Show. And I had heard of Lee. I knew a little bit about him before, and I'm sure I'd probably met you in maybe other environments. But on this panel, we kind of got to know each other a little bit more, and Lee offered some really good advice to the audience about larger HMO developments that he's done down in London. So I wanted to invite him along this month to talk to us about what he's done, how he works, and also to talk about his principles in design. You know, why does design matter, and can it make an impact on your bottom line? So he's going to be sharing tonight some of his design principles and how they work in his business. So let me tell you a bit about Lee. He's been investing since 2007, so he's got lots of experience, the highs and the lows of HMOs. He lives and breathes the HMO model, a bit like me. He's been in a sales role previously, so he's a social beast. He enjoys helping others, and I've seen that in person. He's really good at offering sound and great advice to people looking to invest. He's also quite a tough guy. He used to be an Ironman triathlete, would you believe it, a long time ago. But I'm sure there is still the triathlete in you waiting to launch out at some point, Lee.
Once been quite shy, perhaps.
Yes. So he runs Urbanshare.co.uk, who have managed over 3,500 tenancies in their time and pride themselves on service values, compliance, and a great renting experience. So very much into high quality experiences for those tenants. He's also a partner in helping investors create great property investments to develop mostly HMOs, but he's also done some flips. And in his private life, he is a dad of 2 boys, and he also has Labradors who he likes to work and train. And he believes that in a work-life balance, it's about trying to enjoy the majority of what he does so that he can spend time with family and friends and give the best of himself to other people and also to himself. So I'm really pleased to invite Lee along this evening to speak to us.
Brilliant. Thank you very much. What a lead in. I better deliver now, hadn't I? So let me take over and share the screen. So just checking that you've all got my screen slides there. Is that right, Wendy?
That's amazing. That's brilliant. Thank you. So what we'll do during the webinar is anybody who wants to put in questions into the chat panel or into the Q&A, I'll be monitoring that. And if there are questions that I feel that, you know, we need to speak up straight away, I'll mention those to Lee and he can pause and answer them. If not, we'll save the questions till the end, and we've got a bit of time for Q&A at the end. So, but yeah, take it away, Lee. Thank you very much.
Okay. Yeah. Thank you. So, well, look, welcome. Great to be here. Great to be sharing good content. As Wendy just mentioned, I get a real passion from sharing and content and helping others. And so hopefully, whether you're HMO investing, whether you're considering using commercial lending, whether you've got some current issues within your build teams and you're not sure how to get over those, or you're stuck trying to really engineer the outcome you want at the end of this whole process from purchase to refinance. Hopefully there's some nuggets in here that you'll be able to take away. So if you're a complete newbie to the HMO world or you're a seasoned investor, I'm hopefully confident that you'll get something from this session and be able to take away some little golden nugget of information. So the whole subject that we're going to talk about tonight is, can great designs create greater returns? And you'll see that there's a play on words as we get further into the slides tonight, because I personally believe that design runs far, far deeper in our projects, and it's something we should consider right from the very outset when we're offering on properties. But more about that to come. So let me just set the scene a little bit. And there's a couple of stats here that just really cement all of what Wendy talks about in HMO success. And as we all as investors know, that holding these property assets is absolutely the right thing to do. Asset wealth has delivered very, very well for centuries and continues to deliver very well. And the game is obviously acquiring and holding assets, benefiting from cash flow and asset growth. And as you can see, 22% asset growth, average across the UK, £55,000 worth of value added so since 2020. Material prices during refurbishments, though, have been hard to monitor. And actually, the initial storm when I first put this slide deck together has settled, but it is tough to negotiate what's happening with build prices. And it's also important that as investors, we're sensitive to our builders, and especially if we're asking for sort of an all-encompassing price, that we need to be sensitive to the fact that builders' margins either could be being eroded or they could be finding it very hard to give a price and to actually earn from the projects what they need to earn to sustain themselves and support their family lives. So it's just something we should have an eye on. And if you're monitoring your build costs for an HMO that you're doing in 2024, based on a build that you'd maybe done prior to 2021, then I'd certainly be exercising some caution on the numbers that you're putting forwards for your renovation and in particular material costs. And obviously for larger projects, thinking about using a QS to support yourself and the builder to actually cost materials accurately and give you some sense of completeness that you're not going to come unstuck in the process. So a little bit about me. I'm just going to steal a couple of slides here just to tell you why I'm here and why I'm talking to you tonight. So I have a business called Create with a business partner, Peter. We set the business up a few years ago, and I'll just steal a little bit of time to tell you what we've been doing. So we've invested £7 million of investors' money into properties. There's a big number there, so I better explain that one. Over £170 million of construction work project managed, and that's because my business partner, Peter, comes from a background of construction management. So he likes to play with concrete and cranes, and that's his past life. We've had to play that down a little bit because we're not playing with cranes anymore in our current developments. But nonetheless, brings a real wealth of knowledge in project management, and some of that you'll see run through a couple of these slides that I'm sharing with you tonight about some of the things he's brought from his commercial life as a project manager into our Create business for primarily HMOs. We've managed over 50 construction projects, and actually most of those, or certainly a significant number of those, are HMOs, and they're HMOs in and around the Southwest London corridor. And actually that's an old stat now. We've got a rental income that's pushing 450,000 now per annum, which we're very proud of, but we've got a long way to go to continue to build those numbers. Wendy mentioned Urbanshare. This is our office where I'm sitting tonight. We have managed over 3,500 tenants in Southwest London. We've definitely seen the good, bad, and the ugly, and we've got an awful lot better at it and more systemized as we've gone. But I'm proud to say that actually it's only the minority that have caused us issues. And actually we've had a great experience with the majority of people we've placed in our properties. We actually manage now over 350 units, and we're Arla Property Mark protected, and we're also chartered with the Institute of Builders. And for us, it's all about giving that top level of service. And you'll see in the next couple of slides our target audience and who we're looking to rent to, and why we feel that that's added service and added value that we bring to our properties is so important. I'll do a little bit of talking because I like it. We've spoken to the Property Advantage, the PIN Investor Network, Online Property Meet, Your Property Network here tonight. We had this property that I'm talking to you about this evening was also in the YPM magazine. And we're very proud to say we won a couple of awards just 2 years ago, and we're re-entered for them this year. There's a very tough audience for these awards this year at the HMO Awards, but we're in and we're shortlisted, so we'll see how we get on. And so please send me some good vibes in the hope that we may place well again this year. So why are we working in HMOs under the brand of Create? Well, our mission is to deliver exceptional living spaces to the top 5% of the rental sector. And in Southwest London, and obviously this strategy would vary through the country, but we we believe that we want to set ourselves in the top 5% to come out of the majority of stock that's available in our area. In a good market, and we're experiencing a really boom market for tenanting right now, we can rent any room to any person, and our voids are very minimal. But actually, our properties need to be set up to perform in any market and to the very best of their abilities in any market. So when the market tightens up, because we do go through cycles in property where, you know, there's an abundance of tenants and then things are a little bit tighter and we work a bit harder sometimes to maintain those voids to a minimum. When the market does go through these cycles of tightness, we don't want a product that's compared only on price. And that's really, really important for us. If I've got a very vanilla white-walled product and Mr. Landlord down the road has a very vanilla white-walled product, then actually we're not really differentiating ourselves to our tenants or to our potential tenants in anything other than price. Because if we've got the same product, it may actually come down to, well, which one is going to give me the best price for me to move into? So we want to build a more bespoke product, something that we feel doesn't really compete with the market, so that we're not racing to the bottom on price, and we're always going to be able to comfortably achieve the rents that we want to achieve on our properties, and also the rents that we need to achieve with the amount of investment we make into them. Why co-living? Well, we believe generation rent is continuing to grow. Like it or not, it's harder and harder to be getting on the housing ladder right now. And we're also seeing sub-markets emerge in co-living. So typically when people think about white collar or blue collar worker co-living, they think about 25 to 35-year-olds post-uni, first job in a city, moving away from the uni experience or moving away from mum and dad and cutting their teeth. For us, it's in the big smoke in London, cutting their teeth, coming to this wonderful place to experience their first big job. But actually what we're seeing now is there's a market emerging for people that need to be in HMOs into their 40s and into mid-40s as well, because they're just struggling to make that step onto the housing ladder, or some don't actually aspire to be on the housing ladder and are kind of, you know, quite comfortable, or as comfortable as you can be with a life of renting. And so for us, it's like, you know, how can we make that experience stronger and better for these people that, you know, are going to be living long-term in co-living spaces? And how can we make them proud of the environment they live and happy with the environment they live? The other side is that we've actually seen tenants that move out from our properties. We've had this happen several times, to move into flats and kind of take the next step up from a co-living to a one-bedroom flat, but then actually come back to co-living, not always because of financial reasons, but sometimes because they genuinely miss the people they live with. They miss that camaraderie, they miss that house share environment, and actually felt quite lonely as an individual in a one-bed flat. So for actual social reasons, decided to make that change. So we believe it's a massive continued growth market. And actually when finances tighten, we believe that the trickle down from one-bed flats back to HMOs will also really support us in that market space as well. I think I've covered most of that off actually already. So we're looking to bring forward the best type of products. And the other thing to point out is we're a scaling business. And because of that, we have systems and processes that we've put in place over the years. And we believe that sets a standard that's potentially over and above maybe the part-time landlord when they're first getting going. And I think all landlords aspire to give the best possible service and aspire to, you know, the majority of us as landlords are out there to do a fantastic job and give a fantastic service. And certainly anyone that's joining Wendy's program absolutely aspires to do that. But because we've had a little bit of scale, we believe we're best placed to offer really strong services to our clients. So guys, who remembers this saying? The government kept touting this saying around to us. We're going to build more houses. We're going to build better. We're going to build quicker. And they made this big song and dance a few years ago that's it. There's a housing shortage in this country. We're crying out for more stock. But don't worry, we've got this. We're going to build. And what did they say? Well, they said they were going to build 340,000 new homes every year until 2031. woohoo, they're going to solve all the problems. And, you know, everyone was going to have a lovely home to live in. Well, what I can tell you is between 2015 and 2019, they built 190,000 a year. And what I can tell you is I've just looked at the stats for last year and it's actually gone down. So the stats for last year were 176,000 new homes. So they're literally just about hitting 50% of the target that they've set themselves until 2031. So the good news, guys, is there's a huge opportunity for us as private landlords to keep growing our portfolios, being amazing housing providers, but also our country needs us. We've got to get this stock out there. We've got to house people. So yeah, the demand is there, the need is there, and we're here to do our bit to fill that housing demand and benefit as investors in the process. So guys, what I'm going to share with you tonight is how we're doing this in Create Property and the systems that we use to make sure that we design the right process in our build structures to engineer the right outcome. That's effectively what we're going to do. So whilst I'm not a big one for acronyms, I'm sure you're all familiar with the BRRR process. So for us in Create, we're looking to acquire an asset and we're looking to buy at the right price. That doesn't always mean hugely discounted, because in London, that's often quite a challenge, but it does mean that we're buying at the right price. We're then looking to uplift the value of that property, and we're looking to extend it and add as much square footage as we can to that property to maximize its rental ability and maximize its end value. We're looking to do that also because a common funding route for us is commercial finance. So I can talk to you guys a little bit more about commercial finance tonight. There may be some of you on the call that have done commercial finance. There might be some that are just sticking with traditional HMO mortgages, but I will share some wisdom with you tonight around commercial lending as well. So we pick the property up, we carry out the works, we extend it, we then rent it through our business. So we have the control element there. And then obviously we're looking to refinance the property. At that point, we can pay back investors' funds that have come into the business. So we take the money in through Create to Buy in the first instance, and on the refinance, pay investors back. So that would be a debt lending model. So by debt lending, I mean, Mr. Investor, please give me X amount of money for X amount of time, and I will give you X percentage return on your money. That's a debt loan, has a deadline to it, and through responsible conversations up front with our investor, we can say, well, actually, Mr. Investor, we believe we're looking to borrow your money for 12 months, but we would like to discuss worst case with you, because we know that lenders can take a while to get finance through. And we also know that we're in a slightly turbulent market and we don't know what surveyors are going to say at the back end. So responsible conversations are had with our investor to manage all the potential downsides of that investment, and the fact that ultimately our goal is, and we believe through careful planning, we will be able to repay our investor on time and correctly. But it may be that if situations out of our control prevent us from doing so, that we may need to hold the money for a bit longer. And we've had to do that on one occasion, and it's really responsible of us to have those chats up front with our investor. The second type of lending that we could look for is an equity lending deal. And that is often quite a nice way of managing risk and managing expectation, but it does involve you giving up some of the equity or some of the equity ownership of that property. So it may be, for example, that you as the investor put in all the time and all the efforts, but somebody else puts in the money and you take a 50-50 or a 60-40 or whatever you decide to do split on the rental income and on the continued capital growth and success of that asset. So you're sharing in the risk and sharing in the reward with somebody else. And of course, that doesn't necessarily have a deadline attached to it, because often when people are looking to buy assets like this, we're looking to hold for the long term. Not always, but often that is the route that people are looking to achieve. So debt lending or equity lending following this kind of BRRR model. So here's my play on words for you. Is design just about the pretty pictures? Well, come on, guys, we all love that first day when we've put so much work into sourcing and renovating that property, coming up with the specs, color palettes, soft furnishings, furniture, and we stand back and we see there's photos all over social media of beautiful HMOs that are being designed, and we're all very proud of that outcome, and we're very proud of the amount of time and effort that we've put in to achieve a really great product that I know is going to fly out the door and create a wonderful home to our tenants. So we've karate chopped the pillows, we've got someone in with a flashy camera, we've maybe done a video tour, but actually that's the last part of the design process for us at Create. So what Peter and I do is we look to have design run all the way through the system, right the way from purchase and to refinance. So there's 4 steps that I want to share with you this evening, and I'll take you into some detail in each step. So one is obviously about buying right, buying that right property in that right location at the right price that gives the right opportunity. Breaks then go on, because you need to detail well. And actually, sometimes when you're buying a property, you may have one school of thought for it, but actually through the process of buying, your thought pattern could change and you've got more time to give it more thought, and you might find another way of monetizing it or a way of improving its income further, or improving its desirability further, which of course can improve income by decreasing voids. So it's really about exploring all the options that are available to you with that asset, and not getting, and you'll see when I go into a few more slides, not getting tunnel vision that, well, I've done one like this before, so we'll just do this again. You know, is there another way to achieve a better outcome? For us, it's all about build quality. If we're looking at commercial lending, it's absolutely important that we can evidence the detail of the quality of build that we go into. And I would say, even if you're not looking at commercial lending, you want to build a really well put together, durable asset. You don't want lumpy maintenance bills eroding your margins in the first few years of ownership. And you want a product that's going to sail on into the distance with some really reliable income streams and just minor maintenance and minor touch-ups along the way. So it's, for us, it's about how can we build that product right first time and put a really durable finish together. And of course, the last thing we need to do is make sure we refinance. And now the holy grail, of course, is that we're able to recycle our money back out the deal. That's not for everybody, because some people might be quite happy to leave some money in the deal. They might be happy to take a very exciting return on that money that's left in the deal. But if we can always work the numbers based on a money out principle, or based on a low money left in principle, then that's fantastic. And it obviously allows us to move at a better pace. So these 4 stages, for me, we need to design, and we need to design in reverse, so that we can get the best possible outcome. So if day one, we knew our end value, that would be hugely helpful to us. It gives us something really important to aim at, or really focused to aim at right from day one. So, you know, we might feel that we've bought at one price, we're spending X on the renovation. We feel that the market will allow us to get a back-end valuation of this, but actually we try and take steps further to really underpin that end value and make sure we're absolutely going to get it, and try and put as many controls in that process as we can. So let's talk about the first step, which is buying right. Okay, so we need to source these properties. We need to go out and find these assets. So good evening, George, walking behind me. Hi. So we're finding these assets, and obviously we're building relationships with good agents and agents that we've bought through before, and we're letting agents know when we're in the market to buy, and we're also letting agents know, you know, what else we're doing in the market, so they can see that we're active and they can see that we are genuinely taking positive steps. And also we're keeping in touch with those agents so that we're front of mind with them. So all the stuff that's kind of quite run of the mill. But what we also do in our business is we use Asana, which is a free tool. I'm sure many of you use it in your businesses, but we use Asana so that we can log our property deals and our property offers, and all the due diligence we do around a property. So you can see some examples there of properties that we've analysed and potentially offered on, or in the process of offering on, or they've sold subject to contract. But they stay in this workflow for us, because you'll see in a slide's time that for us, the secret, which isn't a secret, is that we do a lot of work in the follow-up. And actually a lot of our deals come from the follow-up and staying fresh in agents' minds. So it's really important that if a deal comes back to us in 4, 5, 6, 8 months' time, that we've got all that information somewhere so we can quickly reference it, look at the deal analyzer, look at the analysis we did about the demand in that street, in that area, look at the London plan for us so we can see what the saturation for HMOs in the areas, if it's going to require planning, for example, and we can start to understand our chances of achieving planning. If we're going for a planning game, we can start to understand the numbers of the deal again and make sure that that 4, 6, 8 months later, when it's come back to us, that we're just as excited and motivated to put that same offer forwards again, or similar offer forwards to attain that property. So yeah, we do quite a bit of due diligence, so posting lots of links, comparables, put our deal analyzer in there and make sure we've got all the information we need to get going and review that opportunity. So here's a property that we bought. And in fact, this is the one in the slide deck tonight. It's it's an ex-local authority 3-story townhouse. It's not a pretty property. It's very overgrown. It had been empty for some time. It's a rental investment that had just been left to kind of crumble. And we didn't win this deal. But what we did do is we kept in touch with that agent. And actually, 6 months down the line, when the current landlord and agent were absolutely sick of the buyer not performing, they did actually call us up and say, guys, you've been keeping in touch with us. Are you still on for this? And we said, absolutely, we're on for this. And then the process switched over to us so that we could prove to the agent we could perform and take the deal. This property, who here would ever consider waiting 12 months to complete on a property you've offered on? Because this one we had to. And actually, there's a couple of good reasons here. One is from an investment point of view, and one is from just being a good human point of view. So we offered on this property. The elderly lady that lived there on her own, the property was falling down around her, bless her. She'd fallen down the stairs. She couldn't live in a house with stairs anymore, but she was moving into assisted living, and the assisted living provider, who we won't mention, was just dragging their heels and taking an awful long time to get her out of this property and into this assisted living. And it was really painful to see. But the one thing we could do is reassure her and reassure the agent that we were still there and we were still able to perform, and that we just wanted this to end for her and her to be able to move on. So much so that our valuation expired and we had to pay for another valuation. But 12 months on, I think it was actually nearer to 13 months in the end, we were able to pick this one up and complete on it. So it's just being true and keeping following on. And then this one hurts me actually, because we actually offered slightly more than the offer that was accepted, but they preferred the other offer. So this one still sticks in my throat a little bit, but again, didn't perform. And we were able to keep in touch with the agent who we'd actually taken. And this is another thing that you might want to consider. If you've got 2 or 3 excellent local agents, we invited them round to see a recent renovation and show them the level of work and detail we'd gone into. And so they were really inspired and excited by the work we'd done. And actually, when they realized the buyer wasn't performing on this one, they were really pleased to ring us up and say, we know what you did with that property. You could do it at this property. We said, yeah, we can. And yes, our offer's still strong, and we were able to go through the purchase process. So guys, my one big tip about buying properties is keep your data there for you to review, and absolutely keep the follow-up going. And it's not to bug agents, but it's just to let them know that you're keen and you're there, and ask them what's going on in the market, and then just drop into conversation. By the way, how's 123 Acacia Avenue getting on? And just be that good person they want to refer back to when the time is right. Okay, so we want to show ourselves as a professional entity, especially in the commercial lending world. So what we do is we put together a survey pack, a funding pack that we can give to the surveyor, so that they can see what we plan to do with that property asset, and also they can see the level of knowledge and attention to detail we put into this property. So we're setting our stall out from day one as a professional HMO operator, And you can see the level of detail that I'm going to just cover with you here. So we'll put together a pack. We talk about location, property, plan, summary of works, who our target tenant market is. We give some examples of stuff that we've already done, and we also give them some local market comparables. And guys, you may have come up against this with surveyors, but actually they do struggle for HMO comps, because it isn't like getting a comp on a 1-bed flat or a 3-bed house. So actually putting together this professional pack and giving this information to surveyors is well received. And certainly in our area, it's well received. We now use the same surveyor on all of our deals. Shock horror. It's very hard to do that in HMO buy-to-let lending, but in commercial lending, we've got a relationship with the same surveyor. He's on the VAS panel, so he's on with all of the lenders and all of the bridging lenders, and we're able to use that same company. So we've got that repeat relationship. They know us, we know them, they know the standards, and they know that working, we make life as easy as we can for that surveyor to value that property. So we'll talk about the location, why we're buying in that location. We'll talk about the 2 options and brief schedule of works that we plan to do on that property. So we kind of give a best and worst case option depending on the planning gain and how the planning goes. So we show our knowledge that we have a backup plan should we not achieve the sui generis planning for a 7-bed, for example. We also give indicative numbers. So we try and outline our build costs, so we can show that we're capable of putting together build numbers and real world figures. And that gives the surveyor confidence that we're not doing it on a shoestring budget, and that we're aware of what it's going to cost to bring these developments together. We talk about tenant demand. We talk about the rooms that we've achieved rentals on recently, what's in the market currently, reviews from tenants that have currently rented from us. So we show ourselves again as professional operators, and also some live spare room links of what's actually out there right now, what's renting in the market right now, so that we're kind of just picking up and just doing a little bit of the legwork for them and just helping them along their way. And then as a result of that, we get an anticipated GDV. Okay, so day one, our surveyor turns up and says, your gross development value based on the works and the pack that you've put together, in this case, is £1.125 million. And by the way, guys, you're offering at 560,000 to buy this asset, and we underwrite that. We believe you're paying the right price to buy this asset. And so now we've got this document, we've got this pre-work survey that underpins an end value for us that we now have to shoot for. So we've got a target in sight. We've now got to deliver on the steps that we said we were going to deliver on to get that end valuation. And that's the really important bit for us. So we try and take as much guesswork out of the process and give ourselves as best firm chance of getting to that end valuation. And of course, what that also does day one is it underpins that we're on the right line. Because if that post-works valuation came back significantly lower, we'd be really questioning, are we buying the right asset? Are we doing the right thing with this asset? Or are we happy to leave that amount of money behind, and how does that affect our return? So getting that end value for us is something that really underpins our processes. So that's about buying. So we've now, we've found it, we've now financed it, or we've certainly, whether that survey related to a bridge finance or bridge to term lending, that for those that are familiar with that, the same lender puts you on a bridge and then puts you on a term mortgage at the end, or whether we just went onto a bridge and went out as a commodities market at the end and actually looked at what mortgage rates are available at the end. We've now got to the stage where we've got to deliver this thing. We've got to build it out. So who likes drawing on floor plans? And if you say you don't, I know you're fibbing. We all love a doodle on a floor plan. And actually, I've been doing it a long time. I don't know it all. I really don't. But I'd like to think I've learned a lot along the way. But I've done 2 of these properties in the same development already. So this is the 3rd one. So out comes the pen. We're going to stick an ensuite here and here. We'll convert the garages into bedrooms. This is what we're going to do. This is how we're going to make it work. And Peter said to me, hang on a minute, why don't we enlist an architect on this project? And I said, really? okay, but why? We're not extending, we're not going into the loft space. We've got 2 around the corner that are already done. And he said, well, look, let's challenge ourselves. Let's see if an architect that has not got any preconception about what's gone on in these buildings before could come up with a scheme better than us. So we're used to doing all our doodles, putting in 6 bedrooms into this property across 3 floors. But when we enlist the work of a professional architect, and of course, guys, there are architects and there are architects. There are architects that do huge family builds, and there are architects that are used to working in the HMO space. And I'd encourage you to find that right architect. It's just like any segment of the industry, a professional in the sector, but you want a professional in your niche. So you need an HMO architect in my mind. So we reached out for a feasibility report on this property, and we started to get different options coming through. And I was really pleasantly surprised by the options that were coming through. And I'll talk to you now about how paying that architect's fee on a property that I really didn't think needed it absolutely paid dividends for us. So here is the floor plan that we had from the agent with all our doodles on it. So if I can draw you to the ground floor, left-hand side of the screen, you can see my plan was to put in 2 ensuite bedrooms, which are labeled there as bedrooms 5 and bedroom 6, and to take the shower out and to turn that into a downstairs cloakroom, and to put 2 ensuites in the bedroom, so there'd be a guest cloakroom, if you like, for visitors to the property. What the architect actually came up with was to put in a studio unit, a laundry room, and of course that second bedroom is en suite as well. But the way they've designed the space has got a much better flow of light, because the property is quite slim and long. So from a desirability point of view, there's much more light now flowing through the property. We've potentially taken 1 person off of the shared living space upstairs. So that's also quite nice that it's 5 people cooking upstairs rather than 6. Doesn't mean that 6th person is isolated. It just means they get the best of both worlds. They can come and socialize, or they can just, be more self-contained if they've had a hard day and want to just cook separately. But of course, that's allowed us to drive our rents up on room 1. Up on the middle floor, the one thing that, again, I would just never have thought of without enlisting professional help, if you focus your eyes right in the middle of the first floor and the staircase, and when it fades in, you'll see the architect came up with a design to move the staircase. So we stripped that staircase out and moved the staircase off to the right-hand side and put it back into a smaller footprint. And in doing so, it allowed us to push out the walls on the communal space to get it just a little bit bigger and a little bit more usable, and allowed us to get a much better flow of space through room 3. So that's a huge win for us, better communals, better bedrooms, use of space. But then by moving the staircase, the magic really happened for me on the top floor. So the other 2 that we've got bedroom 1 and bedroom 2 as en suites. Bedroom 3, let's be honest, it's not a very nice room. It's a smaller room, but it has a massive bathroom to itself that you kind of tiptoe across the corridor with your towel around you. So by moving the staircase, what we've then managed to get is actually 3 ensuite rooms up on that top floor, that all feel better, flow better. Even that 8.1 square meter room, and you can see the red line where the old room was, even that 8.1 square meter plus ensuite size has a really lovely feel about it. It's got a desk in there. We've put some nice designs with the paint on the wall, and it looks and feels really premium. So we were able to up our rents on bedroom 6, up our rents on bedroom 1, and get a much more marketable shared communal space, all by using that architect. So that architect, we believe, increased our rents by about £400 to £450 a month. So it's not going to take us long to pay for that professional fee. So the big learning for me there is absolutely use professionals, use the right professionals all the way through your processes to make the job better for you, but also to make it more profitable as well. Build well. Now, this is something I'm hugely passionate about, because in my mind, there are 3 big risk factors in the build process. The risk comes from lack of certainty of knowledge. Risk comes from confusion, and risk comes in communication. And I have this belief, and I'm sure some of you will shoot me down for it, and you're welcome to challenge me on a Q&A here. But I believe that actually most contractors really want to deliver your project. They want to delight you with a fantastic HMO finish. And they want to make sure that they can deliver that project and they've allowed enough meat on the bone, enough money in the deal for them to build this out for you. But of course, if we don't give that tradesman enough detail, if we kind of offer up a handwritten floor plan and a couple of paragraphs about what we want to do, or even worse still, if we let the builder come up with a final spec, which is a massive no-no, then you're not going to get the right pricing from the deal. So I'm very, very cautious about knocking tradesmen down on price, because some tradesmen will need to do the job because they've got living expenses, families to support. They maybe haven't got as much work on as they need at that point in time, or they've got a gap in their workflow, and your property will soak up that gap. So they want your business, they want to work with you. But if you make them work too lean, they're not going to have a pleasurable experience. They may not want to work with you again, or they may run the risk of running out of money to deliver the project to the standard that you want and expect, because you're going to build out a lovely HMO. So what we do is we invite our tradesmen to Google Drive, and we set up lots and lots of information in there so that we really take all the guesswork out of their pricing. So our architect, even on that project you just saw, will produce a set of working plans, a set of demolition plans, so they know which walls are coming out. If anything's structural, then there'll be structural calculations done ahead of time before we're getting builders to quote. There'll be a set of fire reg plans, so protected route of fire escapes, where the fire alarm systems need to be, which doors are FD30, if there's any FD60 doors, 60-minute fire protection, if there's anything else, pink fireboards in different areas, where the protected routes are. That all goes into that file so the tradesmen can see it up in advance. We'll have an electrical plan, because again, we don't want tradesmen guessing where sockets are going, and we don't want to hold people up. We want to say, look, here's our professional set of plans. You go first fix and follow those plans. And we're leaving less ambiguity out there. There's less chance of them having to start chopping walls out because things are in the wrong place. Things that really irritate tradesmen on jobs where they're having to go over the same ground again because of changes in decisions. That should all be ironed out at the beginning. Set of plumbing plans as well, so our plumbers know what to fit out and where to fit out to. And we'll put in photos of the current building, and we'll put in some examples of the type of finish that we expect, some photos of a previous project that we've done. And all that information will be in there for the builders to quote from. The architect will have come up with some specification for the main builder, but we also have the experience now to write plans for our plumbers and electricians and our decorators. And the reason we do that is we want to simplify the process. So for example, a plumbing plan might say, we'd like you to install 6 toilets, first and second fix. We'd like you to install 6 basins, and we will put the type of basin. It's going to be a wall-hung vanity unit, for example, and we would like the pipework concealed within the wall. We'll then say we're going to install 6 times showers, and actually we would like external shower valves fitted. So we'll go into the level of detail to take guesswork out for the tradesmen, so they know exactly what they're building, and that they don't quote and then you provide them with some fancy piece of equipment that's going to take them 3 times as long to first and second fix. And they think, I didn't quote for this, but I've now got a difficult conversation to have with the landlady, or I've got to suck it up and get on with it, and they're on the back foot. So we provide all that information. We make it quite clear that they're to provide all the first fix materials, and we'll provide the FF&E, the fixtures and fittings of the second fix, because we want to control the price and the quality of the second fix material. And then we ask for quotes. And because we've given so much detail, we get accurate quotes, because nothing is being left for guesswork, and our tradesmen don't have to add on a margin to cover themselves, or add on a ridiculous margin to cover themselves, because they don't have the detail to give you accurate pricing. So for us, it's not about beating the contractor down on price. It's about giving them enough information to give you the right price. And that's how we work with our tradesmen, and that's how they're motivated to keep coming back for more jobs with us. So guys, we're at that point where I've got to share with you some photos, because everyone likes a before and after photo. So this one is this tired 3-story property. This is the condition that we picked it up in, to give you a bit of an idea about what's going on. It was rented in this condition. It was just a tired old rental property. And obviously what we had to do was pull it kicking and screaming into the 21st century. So this is the finish that we've gone for. We did work with an interior designer as well, but purely for the color palettes and purely for some contrasting textures and things. And we now use an interior designer that actually goes a bit further than that and produces some specs for us, and furniture, and comes up with some packs so that literally we just have to go through and place orders against her specification. Just point out a few things for you, because we're going after white collar London tenants here. So we've got glue down Cardine floors, which are a commercial grade floor throughout the properties, and they're fitted really well. They're super durable. They can cope with a bit of a leak from a washing machine or a fridge. They're not going to bubble up like laminate, and they're going to give us a much more long service life, we believe. We put in stone worktops. Again, longevity, that quality finish. This house has got a Quooker, I shouldn't quote the brand because it's not a Quooker, but a hot water style tap. So there's no kettle. They've got instant hot water for making hot drinks. Other nice touches, there's different lighting zones. There's built-in bins. There's things that are thought about in the design to make it usable and functional for our tenants. There's a little breakout area there where they can sit and work. There's a Wi-Fi mesh system, which I think is it's an expectation these days to put Wi-Fi mesh systems into properties with big, powerful supplies. There's desk spaces in the rooms. There's breakout space in the garden. There's bike lockers that are secure and hide the bikes away from prying eyes. We've got laundry rooms, washer dryer spaces. So things that a lot of people are doing these days, but we're just considering the durability and the style. And I think the one thing that I would say is, if you see your tenants on social media with images of themselves in your property, then you know that you've done a good job, right? Because if people are proud of where they live, then it makes them feel good about the space, and you've delivered a great product. We'll put dual lighting in, so tenants can switch off their bedroom lights from bed, but much like a hotel. We will put in heated towel rails in the bathrooms. So I think that's on the next slide. So for example, there's a little boost switch you can just see on the wall there, underneath that white towel rail, and that works independently of the heating system. So in the summer months, you can just hit the boost button for half an hour or 1 hour and dry your towel post showering. So you can do that without having to put the whole central heating system on. But of course, it's not going to cost you on the earth, because it's only coming on for 30 minutes or an hour, but it's a nice service touch. So just little things that we can do to make people's lives more comfortable, we'll do it. But of course, we're always monitoring the price and functional form and durability of our product. So I've shown you some pretty pictures. What I now really need to do is tell you about the money in this project and how the project performed. And then also at the end, because this was a really successful project, I'll also tell you a little bit more about what happens when there's a hurdle in the way and how you overcome these hurdles, or how we've had to overcome a hurdle. I think it's really important to keep it real. We all shoot for these really good projects, and we want to make sure they're not a one-off and they're not a unicorn. But actually, if it doesn't go quite right, what do we do? How do we deal with it? So let's set the scene firstly on this project. So look, we've delivered. We're now going to get our surveyor back. Okay, so now our post-works valuation pack is showing the surveyor what we actually achieved. So again, we're showing him we know our stuff. We're showing him the actual budget that we spent on this build to the point, and we're breaking it down quite clearly and concisely so he can see the money that's gone into this building. We're going to give him all the information that they need to know about the tenants we've actually rented to. And we're going to give them every single document they need to be able to do a valuation of this property. So we're going to put in a Google link to the 6 tenancy agreements, any planning information, any HMO licensing documents, gas safe, EICR, fire alarm certificate. Not pat tests when they're brand new, but all the certificates that we have that we need to put in there will go into this pack, alongside the tenancy agreements, alongside planning, building control, structural calcs, so that everything is there and they can see that we've run a really tight ship and delivered exactly as we said we were going to. Once we've done that, we'll then get them back out to do that valuation. So let's have a look at these 4 sections of how this property actually worked out for us. So in this particular deal, we bought this one for 468, okay, £468,000. And you can see we've broken our refurbishment down into conversion costs and fit out costs. And we've obviously got our financing costs of getting into the deal, our purchase costs, and our professional fees. So that's all lumped into that £681,795. So that's what the project owes us. We then managed to get a GDV on this one of 995. Okay, so this product delivered as a GDV 995, just shy of £1 million. So day one equity 313,000, 46% profit on cost. So it's been a really successful project for us. If we then on this valuation take lending at say 75%, there is the ability for us to actually be able to bring money out of the project as well as all the costs that owed us. So we'd have nothing left in it, and we could give ourselves a payday if we wanted to. And at that point, it's a real personal decision. How hard do I want to leverage? If I have other assets, other properties, what's my leverage position across those assets? Do I want to milk this one harder, or am I just quite happy that I've managed to take my money back out the deal and that's enough for me? So it's a real, got a point there where brakes go on. Really got to assess how hard you want to leverage. This particular deal over the 6 rooms net grosses us at just under 70,000 rental income. And when you look at what that nets down to, we've got a 26,783 gross rental. Sorry, that's a net rental. There's numbers written the wrong way around. Excuse my typo. So our net rental profit pre-tax is 26,783. And of course, we've managed to get all our money back out the till. So our return on capital employed is infinite. We don't have anything left in this deal. So it's a deal that worked really, really well for us through commercial financing and allowed us to produce these great numbers. So just before I go through these last 2 slides, what then happens if you are delivering a fantastic project and something changes? You don't get the valuation you want, or you get the valuation you want, but so we had a situation where we had the surveyor at the beginning say on a recent project, yes, we believe your end value is going to be 1.125 million. And we said, thank you very much. We then actually managed to surpass that. And at the end, they valued it at 1.2 million pounds. So we were really, really pleased with that. And then our lender, who we have existing lending with, turned around and said, look, the market is a bit tough right now, in terms of lending and interest rates. We're actually now only happy to lend to you at 65% loan to value. We appreciate you've got a 1.2 million vow, but we're only going to lend at 65%. Ouch. What are we going to do at that point? How are we going to work through that process? Because on this particular deal, we had a debt lending scenario. So we've taken the investor's money in and we're giving them a return on that money at the end of the deal. So we've taken it for a set period of time. We're going to pay the investor back his funds and a return on his money. But because we had good conversations at the beginning, we're able to speak with the investor and say, look, we've delivered on the end valuation. We've delivered on the product. We've absolutely got the equity right, but we can't release all of the funds to you right now. However, we can keep the funds tied up until we get that further 10% draw, which the lenders said they're very happy to do for us, and review it 6 monthly. And in the interim, we're able to pay that investor a return on the funds left in. And that's a very tough conversation to have, because we're all about delivery, and we're all about working with people and getting it right. But when it doesn't go right and it's not our fault, we delivered, but the lender decided to move the goalposts, we're very fortunate enough to have good investors that we work with that I would say, well, actually, I'm just going to pay that money back into my bank account. And at the moment in my bank account, it's going to get me 4.5%. So I'm more than happy to leave it out with you guys at this percentage rate. We could agree that with them, take the initial pressure off of ourselves, and we can review that on a 6-monthly basis with the investor while we wait to see what the lender's doing. So I think it's really about managing your investors right at the beginning, making sure they absolutely know that you can deliver the project. But if there's, superhuman events that happen outside of your control, what would the outcome be in those scenarios, and what's their view, should those things happen further down the road? So you've got that really honest grounding with your investors day one, and it takes the pressure off you if something moves in the process. So look, I went off on a tangent there, but hopefully that was useful. So look, we've talked today about buying right. So finding the right deals. For us, it's all about the follow-up, and it's about having the right data to always be able to analyze deals you looked at 3 months ago, 6 months ago, quite quickly, and make sure you've still got appetite to buy those deals. Breaks go on. Just because you've done it one way in the past, is that still the best way to do it? Is there a more ingenious way of doing it? Should you use a professional that could give you a different opinion and blow your mind with a much, much better design than maybe you were able to come up with? I've done it twice before. Why do I need a professional? I absolutely did. Then for us, it's build quality. Yeah, we want these durable assets. We want to make sure we set up an income producing asset that isn't going to have heavy maintenance bills for a significant period. So getting that structure right, detailing the build well to our contractors, getting the right quality of finish, and setting the expectations of that quality of finish, and monitoring the build process allows us to deliver on budget, on time, or close to on time, and the finish and durability that we want. And of course, making sure we get to a point of being able to get money out the deal, and get our money back out the deal, or knowing that if we are leaving low money in the deal, that we're happy with the returns that we're getting on that money left behind. So those are the 4 steps that we work through. And obviously, as I said to you at the beginning, and I'm just underpinning now, for us, it's about working in reverse. Yeah, where is my end valuation point, and how do I work those 3 steps of buying right, detailing well, and build quality to get me to that end valuation point? Because that's my jumping off point that I want to underpin. And for us, the beauty with commercial valuation is we can underpin that day one. So that is what we consider design. That's what Peter and I consider design, as well as the pretty pictures at the end, as well as the karate chop in the cushions, and that product that you can feel really proud of when you take it to market and the tenants go blown away and give you some amazing feedback. Guys, has that been helpful?
That has been amazing, Lee. Absolutely amazing. Love it, love it, love it. I've got a couple of questions in the chat panel from Ida. Do you know what? I love your take on it, that this is not design just in visuals. This is designing the process. It's designing the whole business, really, isn't it? This is about structuring a business to create ongoing returns and assets.
Absolutely. So, we are, I think we are naturally a little bit risk averse. And I think also something happens when you have a family and you have this amazing responsibility to provide, but also you also have this amazing responsibility to make sure you manage risk. And so for us, how we can manage the risk in that process so that we reward ourselves and not we're taking as much guesswork out as possible, basically.
I love that. I think that's really, really powerful. Yeah, really great. Okay, so a couple of questions. I'll start from the sort of most recent ones and work my way back, if that's okay. Sure. So Ida asks, how long ago did you do this deal, Lee?
Yeah, good question. So this one we exited out of end of 22.
Okay, so not too long ago, 18 months ago or so.
Yes.
Yeah. Okay, great.
And the one that I mentioned briefly at 1.2 million was that example was mid last year, so mid 23.
Right. Okay, fine. Yeah, just useful to know in terms of inflation and prices and so on, what you're looking at now. I know it was only 18 months ago, but it's amazing how, I mean, when I see the numbers you come up with, they're a little bit eye-watering for those of us who invest north of Watford.
Yes.
On the other hand, your mortgage levels are a little bit eye-watering as well. So it's horses for courses, isn't it? Your purchases are a bit more expensive, but then your mortgages are more expensive as well. So it works out very, very similarly. If you're buying the right deal, if you're buying right to start with, as you emphasized, and you're doing the right kind of development and you design it from the end, then your cash flow is actually very similar to the kind of cash flow we get and the kind of returns. So it can work north, south, east and west, I think.
I know, I totally agree. And actually, we don't deliver every project at this level because, as you say, they are big numbers. But we do enjoy the sort of capital growth of the London market as alongside the income numbers. So I guess that kind of drives us as well, that our properties do perform quite well from a capital growth point of view.
That's true. Absolutely. Okay, so another question from Ida. This goes back to something you were talking about earlier on with regard to your investors, Lee. So you mentioned about an equity lending route. So can you tell us a little bit more about how you structure that? Do you set up a different company, or do you, presumably they're not getting a share of Urban Homes or Create Property Investments?
Oh, no. So yeah, it would be a separate SPV, so separate special purchase vehicle between us and that investor. And then we would have shares in that SPV with the investor.
Yeah, yeah. And then from an exit point of view, you can decide, can't you, what you want to do, whether you're going to hold for long term or sell or buy them out or what have you.
Exactly. And there are obviously massive potential tax implications in buyouts and things like that. So it's really important that all of that is understood from day one.
Yeah, absolutely. No, that's very true. And in fact, I think that's a very good point you touch on there, that as you grow, getting good tax advice that is structured to your company needs, your personal needs, your investor needs is absolutely crucial, because you can spend a lot of money paying for tax or charges, which can be mitigated and alleviated if you know what you're doing.
Absolutely.
So having those correct structures in place is really, really critical. And I think that's kind of important for people to almost be on your radar. I think once you get to perhaps almost 3 or 4 HMOs and you're starting to work with investor finance and maybe doing those kind of SPV structures, you may want to think about whether you could run it within an LLP or having some other kind of partnership structure over the top of it, just to make some of the movement of that money a little bit easier.
Absolutely. Yeah.
Okay, great. So, I mean, I made lots of comments throughout, as you probably saw in the chat panel, because I was like, wow, this is great. I love the design, love the colors. I thought they looked fabulous. Okay, so Ethan asked a question. You supply the materials for the second fix, is that correct? Showers, basins, toilets, etc.
We do, yeah. And so, I mean, look, LMPG is a very popular product that a lot of people use. We don't buy everything with LMPG, but for example, magnet kitchens are very hard to beat on price through LMPG. So we'd like to supply even boilers, second fix, and all the second fix equipment. So from flooring to paint specs to sanitary ware, kitchens, worktops, appliances, we will source all of that ourselves. We don't let the builder run that, because obviously if the budget's running tight on the job, there could be some changes in the spec along the way, or finishes and durability of product that we're not confident and comfortable with.
Yeah, interesting. And so you keep a really close control on that element of expenditure.
We do, and that we believe we can actually save money and increase durability on that, because tradesmen are busy people. So if they get 2 quotes, or if they go back to the same tradesman they've used forever, or how their same Howden's account or whatever it is, ultimately they're not super interested in saving you money. They're just interested in getting the kit and fitting it. So we will drive that part of the process ourselves.
And I think, as you say, when it's an HMO, durability is absolutely critical, because what you don't want is 2 years down the line to be changing out shower trays or shower screens, because they're okay for the domestic market, but HMOs are, well, let's say, need to be more hard wearing.
Yes. Yeah, so we'll put stone trays in rather than plastic trays. We've got some specs that we ask the builders to follow in terms of before they tile, and if they're boarding, what type of board we want them to use. So we go into we drive the detail, but as I say, if we're very honest about that in the build specs, then they know what they're pricing for.
Yeah, fantastic. Okay, does anybody else have any other questions? Now is your opportunity to put them in the chat panel or the Q&A before we close down for this evening. And I do want to say, Lee, thank you so much for being here. It's been really fantastic to see your projects And I just think your whole design process is really sound. It's inspirational, but it's actually very, very sensible as well. And you know what you're doing, you've thought it through, and that's a really kind of powerful system you got there. So, it's
And
great to hear.
and Wendy, if it's okay with you, it's there's no sell here, but if anybody would like a guide on how to actually put together that valuation pack, then if you pop us an email, we'll very happily share with you a guide on how we put those packs together, because we really do believe it's a massive aid in our process. And yeah, so we've put together a little bit of a guide on how to do that. So feel free to drop us an email if that's of interest.
Perfect. That would be amazing. We've got a valuation pack as well that we use and share it with people, but it's always good to look at somebody else's, because I thought yours looked particularly good. So I'll be emailing you, Lee.
Okay, fine, fine.
Marvelous. Okay, well, listen, thank you so much for tonight. It's been amazing. Had some really good comments in the chat panel as well, and I know other people will be watching the recording, so that's great. You've got your contact details there. So thank you so much, Lee. Really good to see you again, and I hope you have a wonderful rest of your evening.
You're very, very welcome. Thank you very much.
Take care.
Take care.
Bye
Bye-bye.
now. Bye.